Picture this. What if I told you there are completely legal ways that some of the wealthiest people on earth pay absolutely zero in taxes? And no, this isn't some sketchy tax evasion scheme that'll land you in prison. These are legitimate strategies written into the tax code itself, strategies that billionaires and mega corporations use every single day. Stay with me because by the end of this video, you'll understand exactly how the tax system really works and why you've been playing by completely different rules than the ultra wealthy. Now, before we dive in, let me be crystal clear about something. I'm not advocating for tax evasion, and I'm definitely not giving you personalized tax advice. What I'm about to share are educational insights into legal tax strategies. Always consult with a qualified tax professional before making any major financial decisions. But here's what's fascinating. The same tax code that takes a chunk of your paycheck every month contains loopholes and strategies that could potentially save you thousands or even hundreds of thousands of dollars. Let's start with the most mind-blowing example. Jeff Bezos, one of the richest people in human history, reportedly paid zero federal income taxes in multiple years. Amazon, the company he built, also paid zero federal taxes for several years despite generating billions in revenue. How is this possible without breaking any laws? The answer lies in understanding a fundamental distinction that most people never learn: the difference between income and wealth. Here's where it gets interesting. When you work a traditional job, you earn income, and that income gets taxed immediately. But wealthy individuals structure their finances completely differently. Instead of taking large salaries, they often take minimal salaries and instead receive stock options or equity in companies. Here's the key. You don't pay taxes on stock appreciation until you actually sell those stocks. So if your company stock goes from $10 to $100 per share, you haven't technically made any taxable income until you cash out. But it gets even more sophisticated than that. Let's say you own millions of dollars worth of stock, but you need cash for living expenses. Instead of selling the stock and paying capital gains taxes, you can use those stocks as collateral to borrow money from a bank. The loan isn't considered income, so there's no tax on it. You're essentially living off borrowed money while your assets continue to appreciate tax-free. This strategy is called buy, borrow, die, and it's completely legal. The die part refers to what happens when you pass away. Your heirs inherit your assets at their current market value, not what you originally paid for them. This is called a stepped-up basis, and it essentially erases all the capital gains that accumulated during your lifetime. Your family can then sell those assets without paying taxes on the appreciation that happened while you were alive. Now, let's talk about real estate, because this is where things get really interesting for ordinary people. The tax code is incredibly generous to real estate investors. There's something called depreciation that allows you to deduct a portion of your property's value each year, even if the property is actually increasing in value. So you could own a rental property that's making you money every month and appreciating in value, but on paper, you're showing a loss due to depreciation. These paper losses can often offset other income, potentially reducing your overall tax burden significantly. Here's another strategy that blows people's minds: charitable remainder trusts. Let's say you have an asset that's appreciated significantly, like stock or real estate. Instead of selling it and paying capital gains taxes, you donate it to a charitable remainder trust. You get an immediate tax deduction for the charitable donation. The trust sells the asset without paying taxes, and then the trust pays you an income stream for the rest of your life. When you die, whatever's left goes to charity. You've essentially converted a taxable event into a tax deduction while still maintaining an income stream. Business ownership opens up an entirely different universe of tax strategies. When you're an employee, you pay taxes on your income and then spend what's left. But when you own a business, you can often deduct legitimate business expenses before calculating your taxable income. We're talking about everything from home office expenses to business meals, travel, equipment, and even certain educational expenses. The key word here is legitimate. These need to be actual business expenses, not personal expenses disguised as business costs. Here's something most people don't realize about corporations. When you hear about companies paying zero taxes, it's often because they're using strategies like carrying forward losses from previous years. If a company loses money one year, they can use those losses to offset profits in future years. Amazon famously did this for years, using losses from their early expansion phase to offset later profits. International tax strategies add another layer of complexity. Many large corporations establish subsidiaries in countries with favorable tax treaties or lower corporate tax rates. They can then structure their operations so that profits are recognized in these lower tax jurisdictions rather than in higher tax countries. Again, this is completely legal when done properly, but it requires sophisticated planning and compliance with international tax laws. Let's talk about retirement accounts, because this is where regular people can really benefit. Traditional retirement accounts like 401ks and IRAs allow you to deduct contributions from your current income and defer taxes until retirement. But Roth accounts work in reverse. You pay taxes now, but never pay taxes on the growth or withdrawals in retirement. For wealthy individuals, there are strategies like mega backdoor Roth conversions that can allow them to get millions of dollars into tax-free Roth accounts. L savings accounts are incredibly powerful but underutilized. They offer a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. After age 65, you can withdraw money for any purpose, though you'll pay income tax on non-medical withdrawals. But here's the strategy: pay for current medical expenses out of pocket, keep the receipts, invest your HSA money, and then decades later, reimburse yourself tax-free for those old medical expenses while your account has been growing tax-free the entire time. Life insurance is another area with significant tax advantages. The cash value in certain types of life insurance policies grows tax-free, and you can borrow against that cash value without creating a taxable event. When structured properly, this can create a tax-free income stream in retirement. Now, here's the reality check. Most of these advanced strategies require significant capital, sophisticated planning, and ongoing compliance costs. They're not practical for everyone, and they often involve trade-offs and risks. The buy, borrow, die strategy, for example, leaves your estate with significant debt that needs to be managed carefully. But here's what everyone can learn from understanding these strategies. The tax code isn't just about collecting revenue. It's also a tool for incentivizing certain behaviors. The government wants people to save for retirement, invest in real estate, start businesses, and donate to charity. That's why these activities come with tax advantages. The key insight is that wealthy individuals and corporations don't just earn money and pay taxes on it. They structure their entire financial lives around minimizing tax obligations while maximizing wealth accumulation. They think in terms of cash flow versus taxable income, appreciate the difference between different types of income, and plan transactions around their tax implications. If you found this exploration of legal tax strategies fascinating, you're going to love my next video where I break down exactly how ordinary people can start implementing some of these concepts on a smaller scale. Hit that subscribe button and the notification bell so you don't miss it, because understanding how money and taxes really work might be the most valuable education you never got in school.